I'm here today with Big Al, who writes research about Bitcoin and other cryptocurrencies. Welcome, Al.
Thank you for having me, Ash. I'm happy to be on.
So Big Al is a pseudonym, obviously, as you've probably already guessed. You work at a hedge fund here in the United States. Give us a sense, as far as you're comfortable, a little bit about your background and how you got into doing what you do today.
Yeah, absolutely. So I guess it's now a little over half a decade ago, I sort of got into the, let's call it quote unquote, crypto space. And it really came out of a lot of game theory research that I had been doing. And, a lot of the game theory research comes about consensus mechanisms and decision theories, a lot about how people interact. And I stumbled across, proof of work in Bitcoin via that. I was participating at that time in some sort of an academic sense with regards to the ecosystem. And from there, I've actually worked in traditional finance, where I focused on one other sector. I won't say that because that will get pretty far into doxing me. But also always crypto broadly and Bitcoin ecosystem. And so I, at the U.S.-based hedge fund, do run a division where we do invest in this space. Our focus, as of today, where we believe and we're finding value to make investments, is primarily in the Bitcoin ecosystem. We keep an open mind, as everyone always should, but that's where we've been finding the value for our investments. But that's a little bit about me.
So let's talk a little bit about the research. Your writing partner, of course, is Alan Farrington from Ballygifford. Give us a sense of how you guys connected about this and when you started writing and what the driver was.
Yeah, so Alan and I have actually known each other for a number of years now. And then we started speaking more and more around, I want to say 8 or 9 months ago. And it was with this sort of birth of, the hype around decentralized finance, or, some people called it DeFi summer and stuff like that. And when we first heard the concept, I think we were both really excited because the concept of decentralized finance, cutting out middlemen, making financial markets more transparent and fair, is a really, really beautiful concept. And as we were kind of working and studying and sending things to each other and peeling back the onion layers, one thing that we found, what was unfortunate, is that a lot of what was happening in DeFi, or being touted as DeFi, was in fact not decentralized nor finance. So we were like, let's write something. And initially it was supposed to be just, a 10-page paper. We started writing it. It was about 30 pages in, and we're like, you know what, we just have to go for it. At one point, this was 72 pages long. So the readers are actually reading the shortened, edited down version, because at some point we did realize we had to stop or just write a book.
So Al, what's the thesis? Give us a sense of what the overarching take is.
Yes, the overarching take is, well, there are a couple different points, but the overarching take really is that in this instantiation of DeFi that we are seeing today, there is a lack of what, to have finance, you need to have a couple of things. You need to have, one, a strong judiciary system or consensus layer on the base. Two, you need a monetary asset as part of that financial system so that there can be yield, lending, and debt that gets repaid in a strong monetary asset. And then there's all these things that can come from that, such as yields and debt and lending. But what we saw in a lot of this is that these are rehypothecated tokens that are made up. They don't have a connection to that real world value. Hence, there isn't really real yield. It is this sort of self-licking ice cream cone of fake yields, and it might be touted or pitched as, you're gaining this APY, but you're gaining APYs in underlying tokens. That is very broad because there's a lot of expansion to that point. But, I always found that sort of the most interesting and most core point of this, is that this actually isn't even finance. This is not what finance truly is.
So you talk about this self-licking ice cream cone. What does that actually mean? If it's not finance, what is it?
The way I explain that is that when you look at something in the real world, it has a yield. So let's say you own a home and you decide to rent out a room. You're getting a yield on that home via the US dollar, right? But in a lot of this DeFi ecosystem, what you're seeing is, one, most of the tokens are just being used to speculate and trade on other tokens. And then a lot of the times when you see staking and quote unquote yields, you're garnering the yield back in that underlying token. So it never comes back to a real monetary base asset. And without a connection to a real monetary base asset, that is not finance. That is just a playground or an ecosystem that's circular, connecting to itself.
So this is really interesting, this idea of this not being financed because it lacks the connection to the base monetary layer. Obviously, there is yield being recognized there. People are picking up yield and then they are selling it ultimately for Bitcoin or for US dollars. So for a skeptic, for a cynic who says, okay, maybe it's not connected to the base monetary layer at core, but because you can exit those positions and flip into USD or BTC or the asset of your choosing, they might say, doesn't it then take on financial-like properties?
I think that actually is a very fair statement to someone who would be skeptical of that. But I think what we talk about, for example, if you talk about specific tokens, maybe Uniswap token or a compound token, some of these large projects, is that if you're saying that then, and you're saying that these tokens should actually retain value, but then you're saying, actually, I'm just going to sell it into US dollars at the end or sell it into Bitcoin at the end, you're essentially saying that it's almost like casino chips. Casino chips, you go to the casino, you get them, you play, and you cash out. The casino chip itself holds very, very little value then. That is what we call a utility token, or businesses would call that inventories. There's personal and private inventories, but these sorts of tokens that have been created during this sort of, I will venture to call it a bubble that we're in, and the excitement around them is that for now you can liquidate. I would love to see how these very large venture funds with huge positions in these things would liquidate, because liquidity dries up very, very quickly when you start to try to sell in size and when markets turn the other way.
So it's interesting. I'm curious, you mentioned a bubble right now in DeFi in your view. Give us a sense of what the metrics you use to make that determination are.
It's a difficult question for me to answer, because when you say with metrics, it is, I could say market caps, and most market caps are pseudo market caps, right? It's what was the last trade at that price, but if you tried to sell in size, it isn't that market cap. I think it is simply the rampant price action up, the amount of new entrants coming in, and then also the amount of people who are again buying tokens that I inherently don't understand why they would hold long-term value, because they're trying to be utility tokens. They're not trying to capture actual financial and monetary yields. So when I say that more of it's more of a social statement than I can point at, look at the market cap. It shouldn't be $1 trillion. It should be 1 billion, because that's a very difficult thing to do in any financial market. And also, again, market caps are not very often a good metric of what's really going on.
So let's keep unpacking this. You actually have a lot of detail in the paper describing your take on DeFi. Give us a little bit more context, a little bit more framework, and a little bit more detail on why you reached these conclusions.
There were a couple of different things. One was, as we were going through the ecosystem and looking at what was going on, one was primarily what is happening, and the primary use cases of what is going on are people speculating on coins that have large APYs, people going for airdrops. And then if you look at what the platforms actually enable, is there some sort of end value? Is there some sort of a capital market being created where a lumber business can raise money to build a new patio in your home? No, it is just people using tokens to trade other tokens to hope to maybe sell that token at a higher price than what they had paid for, what they had gotten into. So that's where it had started, because when we were looking at it again, it just never had this connection back to the real world. And so that was with a lot of the projects. And I can certainly talk about how TVL or different metrics we believe are inflated. Part of the paper, we actually cite one of Coinmetrics' great analysis on that, of how total value locked can be very inflated, how tokens can be rehypothecated. But it does go back to the fact of there's almost no there. It's just, here's a token that's a utility token for you to then trade other tokens to hopefully gain yield in other tokens, and then sell your token, because they're all utility tokens. You don't hold iTunes gift cards for long periods of time. That was back in my day. You get an iTunes gift card, you use it, you spend it. That's an analogy I also like to use. on it. So I hope that was a relatively helpful answer.
Hey, if you like this clip, be sure to check out the full interview and more only on realvision.com/crypto. It's 100% free. Sign up now.